Welcome to this Bell Direct weekly update. I'm Julia Lee, an equity strategist with Bell Direct. And your typical weakness in May has not materialized. In fact, things are looking very good for the markets. We've seen the Dow Jones seeing its sixth consecutive session of gains and now on positive territory for 2018. While here in Australia, we've seen another good week for the Australian share market, now looking to test those post-global financial crisis highs at 6,150 points for the benchmark index. Once again, it was energy and materials, the best performing sectors this week. So let's kick off by having a look at that resource area, having a look at Morgan Stanley and some of those material ideas. It's a timely time to look at this, given that we have seen those quarterly production numbers coming out from the miners. Morgan Stanley does see future upside in Iluka as production in Ambrosia is brought forward. It also sees Mineral Resources gaining on the back of mine life following that maiden Wodgina reserve. Meanwhile, at Whitehaven Coal, Vickery represents an upside opportunity. If we do see environmental approval, well, that could be a positive catalyst for Whitehaven Coal, and Vickery remains the upside catalyst to that overweight weighting from Morgan Stanley to Whitehaven Coal. It, however, has made no changes to the underweight weightings in its mining universe. Having a look at Citi, which is looking at health, and we've seen a number of global healthcare companies coming out with their results as well as some comments which have implications for some of our ASX listed companies. So starting off with Harmonics. Now Harmonics is a plasma collection equipment and consumable supplier to CSL and some of the other players in the industry, and its resultant comments suggest that plasma fractionators are positioning for continued strong end demand for plasma derived products. So the look through and the follow through is a positive for CSL. It has a buy rating on the stock with a $175 target. Meanwhile, WDH is looking to enter the US market. Now, WDH is a relatively small player in the cochlear implant space, and Citi sees a limited threat to Cochlear's business. They have a neutral rating on Cochlear with a $175 target price. And quickly having a look at the budget and the implications for the healthcare sector. This budget is relatively benign for the healthcare sector. There's no cuts to Medicare funding, including pathology or diagnostic imaging, and the budget is neutral for hospitals as well. But looking at that budget in a little bit more detail, and there have been big impacts for two of the stocks on the ASX this week. One is Link and the other is Challenger. Having a look at Link, and this is because of the ATO's the proposed ability of the ATO to actively unite Australians with their lost superannuation accounts and to abolish superannuation fund exit fees. This could facilitate account consolidation and at the margin seems negative for Link, LNK, and possibly a slight negative for the likes of AMP as well as IOOF. Meanwhile, the budget looks to be positive for Challenger. The changes to means test requirements for the age pension should be favourable for the sale of lifetime annuities, and we have seen Challenger shares doing well on the back of that announcement on Tuesday night. Having a look at the consumer, which really didn't benefit too much from the budget, given the long time frame for taxpayers to receive some of those tax cuts. In terms of the consumer, UBS, though, seeing a solid March retail sales number, which came in with an increase of 3.1% year on year, grocery being the standout there. In terms of the consumer stocks that UBS favours, it does like Woolworths, Kogan, Super Retail, as well as Costa Group. In the small cap space, outside of the top 100, it likes Adairs, ADH, The Reject Shop, as well as Premier Investments, while it still has a sell on Myer. Moving from the consumer back to iron ore, and UBS looking at iron ore shipments for April, and this is just interesting. Port Hedland iron ore exports came in at 42.6 million tonnes for April. That's not a huge increase. It's up 1% month on month as well as year on year. But breaking it down into the iron ore exporters, and BHP was down 7% month on month, while Fortescue was up 14.2%. So it could have implications and might be showing that perhaps that demand for the lower the lower value product from Fortescue might be rising and closing that gap against the higher quality product that BHP Billiton has. Finally, finishing off with some asset allocation from Morgan Stanley's. It's long US equities and prefers small caps. It says that President Trump's pro-growth policies profits domestic companies over multinationals. Financial conditions are also favorable, with the US dollar only marginally strengthening, while the cost of funding remains under control, with credit spreads near cycle lows and bond yields only gradually rising. Another positive is the expected rise in M&A activities. It's long Europe as well, but underweight Australia, and of course long late cycle investments with a tilt to banks, energy and materials, and underweight the property stocks, the REITs area. So the market continuing to power on strongly, not only here in Australia, but over in the US and globally as well. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next week.